Hello friends, welcome back to part 18 of my Tesla earnings forecast video review series for 2022 Q3. So named because that's the first quarter that I'm forecasting, but I have a bunch of quarters in my forecast. Let's hop right back to where we left off. In my detailed model tab of my Tesla earnings projection model, as I published to Twitter on August the 19th. So where we left off was covering PEG ratio in the previous video, which I cleaned up the label of a little bit off in column A to make it a little bit more clear that I'm talking about this section and not any of the individual lines in it. At least to me anyway. I don't know if anybody else appreciates these little changes that I make. But I like it better that way, and that's all that matters, I think. So the next section is showing how you get to Adjusted EBITDA. So some folks might just think, well, you just take the number Tesla reports and that's the number. But you can actually calculate it yourself. Even if Tesla didn't report Adjusted EBITDA, you could know what it is using these steps. So you start with GAAP net income, and then you make a few adjustments from there. Remember, GAAP net income, we have already seen up here, I'm forecasting $4,388 million worth of Q3 2022 GAAP net income for Tesla, as they will report it. And then the non-GAAP number is just that GAAP number plus the stock-based compensation. Okay, so that's the review portion. So here's that GAAP number again. I'm going to try to not confuse myself as I talk through this. And to get to Adjusted EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization, surprise, you're going to add back interest, taxes, depreciation, and amortization. And then because it's Adjusted EBITDA, we're going to make one more adjustment to that, which is adding back the stock-based compensation, the same as we did for non-GAAP earnings. So there are no forecasts in here. Each of these are just linked. Well, I guess this one has to be forecast here because I don't have it forecast anywhere else. So I always talk to you about how I forecast stuff. So in the case of these actuals, that's $922 million worth of actual depreciation and amortization and impairment as Tesla reported it in Q2. The way that I solved for this amount was to look at the trailing 4 quarters average and then grow it by an amount that kicked out the reported number. So in order to get from the 4 trailing quarter average to the number Tesla reported, 922 million, I had to grow the average by 16.3%, which is what this coefficient is telling you. So what am I using that for? I just dragged it over. So in all my future quarters, well, for a while anyway, in the next several quarters, I'm going to use that same rate, that 16.3% growth rate on depreciation. What is this line? This is the gradual writing down of the cost of capital assets that Tesla purchases. So in GAAP accounting, which is different from the way that you account for your household purchases in your house and in my house, we use the cash basis where when you pay for stuff, the money's gone. You've already forked over the cash, and now you have the stuff instead of the cash. Well, under the GAAP rules of accounting, if you're buying anything that has a long life and was expensive, then and if that asset is expected to produce value over an expected useful life, you're going to need to record the cost not all at once when you paid for it, but in all of the periods in which those assets are producing value for your company. Any quarter in which those assets are helping to make your company more profitable, you're going to spread that purchase expense out over that period of time. So that's what you're looking at here with this $922 million. That's going to quickly grow to more than $1 billion over the next year and keep growing from there, I think, as Tesla continues to build out more factories and buy more income-generating assets that will depreciate over time, right? So that's my forecast there. The stock-based compensation we've seen already, and that gets you to Adjusted EBITDA. Now, why is it called Adjusted EBITDA? We can consult our friend Investopedia once again to see what the common EBITDA adjustments are. And these are just trying to make a normalized number, as normalized a number as possible, so that you can compare companies against each other on their Adjusted EBITDA metric. And companies are allowed to throw out stuff that that is either non-cash in the case of depreciation and amortization, or stock-based compensation, or is just weird stuff not expected to recur in future quarters. So you can throw out non-operating income, you can throw out goodwill impairments, you can throw out gain or loss on foreign exchange. I don't think Tesla does throw that one out, but you could. Well, who knows what they do. Anyhow, Adjusted EBITDA, you make some adjustments to get to a number that's more reflective of what your profitability was, excluding non-cash and other weird items. And that's the Adjusted EBITDA. Now, there's one more thing here that I'd like to cover in this video before I move on to the next part, and that is automotive gross margin percentage, and then automotive gross margin excluding regulatory credits. So the way I've laid this out here is that you take the total automotive gross margin percent, you figure out how much of that is regulatory credits, and you subtract that out to see how much your automotive gross margin would have been if you hadn't sold any regulatory credits. Now, the way that I'm doing the math is the reverse of what I just said. I'm actually solving for how much the regulatory credits percent of total automotive revenue must have been by calculating each of these numbers independently. So this number has already been shown. Now, I don't show it on my income statement portion here because Tesla doesn't on theirs, but I do have it just a little bit up the page. You remember the fourth major section of my detailed model gives you just the cost of sales percentages for everything. So the total Tesla automotive and leasing cost of sales percent, including regulatory credits, was 30.1%. We've got that number already. So I'll scroll back down, find this row again, and this is, okay, but what if there were no regulatory credits? What would your automotive gross margin have been excluding the regulatory credits? Well, that math requires another section that I have down here, which shows the revenue by type. We'll get to this in a future video. And I have a row for regulatory credits. So my expectation is that in Q3, Tesla will report $356 million worth of regulatory credits. That number's going to be wrong. I hope it's close. And that's out of the $21.3 billion worth of total automotive revenue. So what you want to do is take this number on 1280 and subtract this number on 1278. You see that portion of the math right here. So if the automotive revenue did not include the regulatory credits revenue, then what's the rest of this formula? It's looking at row 1176 and saying, well, this would still have been your total cost of automotive and leasing cost of sales. So you would take that number and you would divide it into the revenue excluding the regulatory credits. I'm going to stop making you dizzy here in a minute. And that's how you get to, let me escape out of that, hit enter. Okay, that's how you get to 28.9%. So if you've got 30.1 here, if you've got 28.9 here, then the difference between those 1.2 percentage points, or 1,200 basis points, or however you want to say it, are the regulatory credits contribution to the total automotive gross margin percent. So why do we care about this number? I don't really care about it that much. Automotive gross margin ought to include regulatory credits and does, because that's real money that you can really take to the bank and deposit. Not only that, it's money being paid to you by your competitors who did not produce enough electric vehicles to comply with applicable law. So you're taking money from the competition who are not selling enough good EVs to people, which is, there's some delicious irony in there, I think, for the most successful maker of electric vehicles. And that money counts, in my opinion. But if it didn't count, the gross margin percents would still look fine for Tesla, with this little dip from 30 to 26.2 in Q2 caused by less of what Giga Shanghai produced getting sold in Q2 due to the Shanghai lockdowns, and I'm forecasting more than 30% margins every quarter after Q3, with a little bit more downtime happening this quarter and some continued cost pressures, potentially. The automotive gross margin, excluding regulatory credits, may not make it to 30% this quarter, but in future quarters I expect that it will, after more of the price increases start to materialize and flow through the income statement. And with that, I will close this video and say, if you've enjoyed today's video, click the like button. And if you're not subscribed to my channel, you can go ahead and subscribe to my channel and click the notification bell if you want to get alerts when I post fresh content to YouTube that you might be interested in seeing. And I'll see you in the next one.